Many of us have probably heard about the story of a friend who has earned huge amounts of money from stock shares. How does it work? Why would a company give money out freely to people? Well, let's find out. Today, we'll be taking a look into stock dividends, what they are, how they work, and if they're worth it. If you enjoyed the video, be sure to subscribe and hit that like button. Dividend payments to shareholders provided in the form of stock rather than cash are referred to as stock dividends or stock payments. It has the advantage of rewarding shareholders without depleting the company's cash reserves. While it can reduce earnings per share in the short term, these stock distributions are often done in the form of fractions of existing shares that are paid out. For example, if a firm declares a 5% stock dividend, it will be required to issue 0.05 shares for every share owned by existing shareholders, meaning that the owner of 100 shares will receive 5 new shares, and the owner of 500 shares will receive 100 additional shares. Well, how do they work? An alternative to cash dividends, sometimes known as a scrip dividend, is a distribution of shares to existing owners in place of a cash payout. This form of dividend may be paid by a firm when it wishes to reward its shareholders but does not have the necessary cash on hand, or when it wishes to keep its cash on hand for other investments. Dividends from stocks provide a tax benefit to the shareholder. The dividend on a share of stock, like any other stock, is not taxed until the investor sells the shares unless the corporation provides the investor with the choice of receiving the dividend in cash or stock. A stock dividend may stipulate that the newly received shares may not be sold for a specific length of time after they are received. The holding period for a stock dividend normally begins the day after the dividend is paid out to the shareholder. When evaluating qualifying dividend tax treatment, it is critical to understand how long a dividend has been held. A 5% stock dividend, for example, may be approved by the board of directors of a publicly traded corporation. Existing investors will get an extra share of company stock for every 20 shares of stock they already possess as a result of this. However, this means that the pool of accessible stock shares in the firm grows by 5%, so diluting the value of the company's current stock. As a result, in this example, an investor who previously held 100 shares in a corporation would now hold 105 shares following the payment of the dividend. The overall market value of such shares, on the other hand, stays unchanged. According to this definition, a stock dividend is analogous to a stock split. This does not imply that the market value of the company's stock will remain unchanged. An important factor driving the stock dividend is the assumption that the stock's price will grow in the near future. In the event that a stock dividend is paid, the total value of equity stays unchanged from both the perspective of the investor and the company's standpoint. All stock dividends, on the other hand, necessitate the creation of a journal entry for the firm issuing the dividend. The value of the issued shares is transferred from the retained profits account to the paid-in capital account with this journal entry. The amount of money that is transferred between the two accounts is determined by whether the payout is a little stock dividend or a substantial stock dividend. A tiny stock dividend is one in which the number of shares issued is less than 25% of the total value of the shares outstanding prior to the dividend being paid. The market value of the issued shares is moved from retained profits to paid-in capital through the use of a journal entry for a modest stock dividend, resulting in the reduction of retained earnings to zero. Large stock dividends are those in which the number of new shares issued equals or exceeds 25% of the value of the entire number of shares outstanding prior to the dividend payment. Specifically, the journal entry in this example changes the par value of the issued shares from retained profits to paid-in capital. When a firm declares a stock dividend, it is giving a dividend in the form of stock, rather than cash, to its shareholders. An additional type of payout, known as a scrip dividend, is one in which a shareholder receives a fraction of the number of shares that are currently held by the company. A 3% stock dividend, for example, means that the holder of 1,000 shares of stock will get an additional 30 shares as part of the dividend distribution if the firm declares one. If a corporation has a limited supply of liquid cash reserves, it may choose to pay a stock dividend to shareholders. If it is attempting to maintain its current financial reserves, it may also opt to declare a stock dividend. Because it raises the total amount of stock available for distribution, releasing a stock dividend basically dilutes the value of the company's outstanding shares. If, on the other hand, the price of the stock rises, this can be favorable to the shareholders. Stock dividends, on the other hand, are not taxed until they are sold, as opposed to cash dividends. If you enjoyed the video and learned something from it, please consider liking and subscribing. It would mean a lot to keep these informative videos coming your way. And if you want to be notified when a new video drops, be sure to ring that bell.